Hello and welcome to Trade Finance Talks. My name is Mark Abrams, Managing Director of Trade Finance Global. Trade finance is a complicated topic, and adding legal topics on top of that can create even more confusion. That's why I'm happy to introduce Jeff Wynn, partner of Sullivan & Worcester, who is here to break down some topics with us today. Jeff, the godfather of risk participation agreements, welcome to Trade Finance Talks. So can you just start by giving an overview of your professional background and current position?
Hi Mark, thank you very much. Thank you for having me. I'm a solicitor. I'm partner at Sullivan & Worcester, as you mentioned. I started the office nearly 10 years ago, but my history in trade finance probably goes back 30 years or more, and my life in the city, I've now celebrated 50 years in the city. So yeah, I've been around a fair bit of time.
And can you explain the purpose of risk participation agreements and how they function in a trade finance context?
Yeah, risk participations, or rather participations, because they is a way of sharing risk, which started off very much between banks. So a bank originated, wanted somebody else to join, but wanted to stay forward-facing to the customer, and therefore it transferred part of the risk of that transaction to another party. Participation agreement was a great way of doing it.
And can you explain the difference in a funded and an unfunded risk participation?
Yeah, as you might expect, funded is where at day one, the seller of the risk is funded by the participant and then pays the money back when it's paid back. Risk is where the risk is covered, but either the transaction itself is like a guarantee or whatever, or could be receivable or whatever, but the participant only has to pay up if there is a default, and so just gets a return for covering the risk.
And what led to the creation of a master risk participation agreement, and how has this standardisation actually affected the way trade finance transactions are conducted?
Well, what led to it was that, and we have to go back to 2008, 2009, before then, there were plenty of risk participation agreements, but everybody was drafting their own. And then a group of banks, ironically led by Credit Suisse, said, why don't we try and standardise this? And so the first BAFs came out 2009, 2010, and then I worked with it, was not particularly happy because, by way of background, the English law one was drafted as a debtor-creditor. So it was structured effectively as a limited recourse loan. The Americans structured it by way of effectively a grant of rights in the underlying transaction. And so in 2018, we were part of the redrafting group. We drafted the English law and the New York law ones as a transfer of an interest in the underlying transaction, which was a nifty way of doing it, shall we say.
And how does the MRPA contribute to reducing the trade finance gap, and what impact might this have on global trade and emerging economies?
You've got a standard way of transferring risk. Consequently, it makes life a lot easier. So if you talk to somebody, would you like to join this transaction? It will be based on BAFT. Already the participant has a pretty good idea of how it's going to become involved in the transaction. That makes life a lot easier. And whilst banks do tweak the document a little bit, that in principle, as I get to look at, somebody says, look, this is BAFT based. You run a comparison against BAFT and you can immediately see the changes. So it makes life a lot easier for people to negotiate what goes into their arrangement. And remember, it's a master. Sitting behind it is then an offer and acceptance for individual transactions. Just a good way of doing business.
And from a legal perspective, what are some of the challenges and considerations companies need to be aware of when they're actually engaging in an MRPA?
We tried to balance the position between the seller of the participation and the participant. But in reality, it's probably seller friendly, in that what the seller says to the participant is, here's all the documents, you decide if you want to go into this transaction, If you do, then you accept my offer and you're in the transaction. I'm not telling you that the documentation is any good.
And in terms from a regulatory and compliance perspective, how do they play into MRPAs and trade finance?
That's actually quite interesting, because the idea from a regulatory point of view, indeed from a legal point of view as well, is you want to make sure that the risk is transferred from the seller to the participant. So seller wants to know it's off its books, either sold it, funded, or off its books because the risk has been taken over by the participant. And round the other way, the participant wants to know, hey, if I'm coming into this transaction, what have I got? Have I got direct rights to the underlying transaction? If I'm funded, if I have to pay out afterwards, will I get direct rights? So they're a mirror image of each other.
Fine. And I guess in terms of the future and evolution, where do MRPAs, where are they going to go? What are the forthcoming developments that you see coming down the track?
Forthcoming, there's a bit of tidying up you can always do. If you think from 2018 to 2023, 5 years ago, hey, there used to be a thing called LIBOR. So we had to take out LIBOR. So there's always something that is changing. But in reality, the point that I made to you about the relationship between seller and participant, it assumed equal parties. It assumed bank to bank. If we're trying to expand the access to trade finance using participations, then the investor says, hang on a second, what do you mean I've got to read 200 pages of documents? I don't do 200 pages of documents. There will be changes to meet the investor needs. That's where I see this going.
Interesting. In terms of something that we're seeing in the market, we're seeing more non-bank originators come in. And this is not just in trade finance. It obviously goes to receivables finance and other forms of credit. And one of the largest issues is that there's huge demands for credit. There's all of these funders, which are not necessarily the core trade finance banks, who are looking to deploy liquidity. And one of the issues is, how do they interact? And historically, and not just necessarily lawyers looking to kind of fees and other things and banks getting overly complicated, but there'll be various different structures. And those originators, there's a huge amount of confusion in the market. So, and what I mean by that is we will see originators who will run sizable books not necessarily know how to take drawdown liquidity from one side and then put it out on the other side. And then you get hit with negative carry and other issues. So everything from structured RPAs to senior financing to back-to-back to flow agreements. I guess the question is shouldn't everyone really be using an MRPA or a similar to a BAFT MRPA? Because one of the things that we see so much in the trade finance and trade finance global world is everyone gets excited with, well, wording like BAFT MRPA, but actually outside of those core banks who use it, many don't know. So shouldn't it be used more by non-bank originators and become more mainstream?
It's a good question. MRPA is a master and was drafted as a two-way. So you could be seller or you could be participants. And that was why it said, well, this is fair because, blimey, if I'm selling, I want this, but if I'm buying, I want this. So let's try and balance it. A lot of the work that we do now is one way, which is exactly right. So the seller says, look, draft me a document that I can use when I sell to an investor. Or round the other way, the investor says, draft me a document under which I will buy or I will take the risk. So you take that template and then you adapt it. And you're right, the variations of what you offer become quite interesting. There's a lot of structural, let's turn the receivable, put it through an SPV, issue notes. And then you get the question of, hang on a second, what am I buying? How far away am I from the promise you said to me, which was an independent payment undertaking from the guy who's buying the goods? Now you're into all the discussion about how clever do you want to be. And I was discussing only this morning about a credit derivative wrap and the insurance wrap and wrap and rating and how do I get this issue rated. And the warning is just to be careful. If we're keeping to simple trade transactions, then we want to keep it simple. To say, hey, look, you wanted to buy a Walmart payable. Oh, yeah. Well, if you go to Luxembourg and you look at the listing agreement, and I can tell you that I've got an SPV, and the SPV, and you say, come on.
No, and I agree with you. Sometimes there is this push to overcomplicate, and we look at not to do everyone out of on the securitization side, but sometimes on larger obligors and actual structures, you don't necessarily need to go down that route. And I guess that for my last question, in terms of how do we get, in terms of comfort, how do we bring more non-bank originators and also investors into the market who have not done trade finance for the last 30 years? How do we get them comfortable using an MRPA or a derivative?
You get them comfortable by saying, if you sign this MRPA, you are getting direct rights against the guy that's paying. So keep it that simple. And then they say, well, what happens if I don't like the credit risk of the guy that's paying? You say, fine, I'll tell you what, I'll give you a guarantee, I'll give you credit insurance, but all the time you get the direct rights. And what you'll be able to do is bring in smaller buyers and sellers, because the buyer, you then say to the buyer, look, if you really want to be in this marketplace, instead of saying, yeah, look, I want my invoice and I want discounts and I want all this, to say, if you are prepared effectively to sign a promissory note that says you will pay in 90 days' time, I can get funding, and I can get the funding to the seller in 10 days. And there's arbitrage, and that's exciting. There's the marketplace.
Interesting. And look, thank you very much. That was great to speak to you, and thank you very much for joining us today.